A new Carnegie Mellon study reveals that AI agents, the technology VCs poured $131 billion into this year, fail basic workplace tasks at catastrophic rates, with even the best systems crashing 70% of the time. Carnegie Mellon researchers tested AI agents on 175 realistic workplace tasks, delivering devastating results that shatter Silicon Valley's replacement narrative. OpenAI's flagship GPT 4.0 failed 91% of basic office tasks. Amazon's Nova Pro achieved a spectacular 98% failure rate. Meta's Llama 3.1 crashed at 92%. Even Google's best-performing Gemini 2.5 Pro only succeeded 30% of the time. These weren't trick questions. We're talking about responding to colleagues, basic web browsing, and simple coding tasks that any intern could handle. The failure extends beyond individual models. Gartner predicts 40% of AI agent projects will be canceled by 2027 due to escalating costs, unclear business value, and inadequate risk controls. Most current projects are early-stage experiments driven by hype rather than substance. Out of thousands of companies claiming to offer AI agents, Gartner estimates only 130 are legitimate. The rest are rebranding existing automation tools and chatbots to ride the current wave. Sequoia Capital's analysis reveals a staggering $600 billion gap between AI infrastructure investments and actual revenue. OpenAI dominates with $3.4 billion in revenue, while other companies fight over scraps in the sub-$100 million range. Unlike previous tech buildouts, GPU computing lacks monopolistic power and quickly becomes commodity-priced. When GPU stockpiles grow large enough and demand drops, we're looking at massive capital destruction across the industry. The hallucination problem remains unsolved and potentially catastrophic. AI systems confidently generate completely false information that looks legitimate. Legal AI tools have been caught inventing fictitious court cases and citing them as precedent in real documents. These aren't minor errors. AI creates entirely fabricated facts, figures, and references that can destroy business credibility. For critical processes like contracts, financial reports, and compliance documents, hallucination creates liability exposure most companies haven't considered. Companies are building critical operations on AI APIs they don't control. When OpenAI experienced downtime last month, thousands of companies lost core functionality overnight with zero backup plans. Startups building entire value propositions on third-party AI models get crushed when pricing changes, access gets restricted, or when providers decide to compete directly. Sending sensitive customer data to external AI providers creates massive security vulnerabilities that violate HIPAA, PCI, and other data protection regulations. The talent gap is enormous. Companies are promoting regular developers to AI engineers after weekend courses, then wondering why projects fail spectacularly. The quality difference between elite AI practitioners and average implementation teams is vast. Without proper expertise, even advanced AI models become expensive paperweights that drain budgets without delivering promised value. Executives blame employees when expensive AI tools fail miserably, not recognizing their own implementation shortcomings. Regulatory reckoning approaches rapidly. The EU AI Act, China's comprehensive regulations, and emerging U.S. frameworks will drastically change what's legally possible. Many startups are building on foundations that will be undermined by upcoming AI regulations in healthcare, finance, and other sectors. Smart companies are building with future regulations in mind, while others risk having their entire business model legislated out of existence. The ROI crisis deepens as reality sets in. Businesses are quietly bringing humans back into every critical process because the cost of AI mistakes consistently exceeds the cost of human review. Companies are adding verification steps they hope to eliminate. Successful implementations are shifting from full automation to practical augmentation that enhances rather than replaces human judgment. The set-and-forget AI fantasy is dying as reliability, accountability, and true error costs become apparent. Investment patterns show classic late-stage bubble behavior. Companies raise $10 billion rounds based entirely on future promises rather than current performance. The disconnect between AI capabilities and public expectations has reached unsustainable levels that always correct violently in markets. Unlike previous tech bubbles, the U.S. economy is now fundamentally tied to AI hype success or its catastrophic failure. Key takeaways. AI agents fail 70 to 98% of basic workplace tasks according to Carnegie Mellon research. $600 billion investment gap exists between AI spending and actual revenue generation. 40% of AI agent projects will be canceled by 2027 due to costs and unclear value. Hallucination problems create massive liability exposure for critical business processes. Companies are quietly bringing humans back into AI processes due to error costs. The expensive lesson companies are learning is that attempting complete automation